Hi there, I'm Steve Williams. Got 15 minutes or so to talk about the economic outlook, what that might mean for investors and some of the main risks as well. Just in the last few days, in fact, we've had the Office for National Statistics providing us with an estimate for economic output or the change in economic activity during April. So April was the first month of the very severe lockdown. May is likely to prove very similar to this. So actually the ONS is one of the few national statistics bodies that does actually offer information on a monthly basis. So this data from the UK is actually of interest to people, to statisticians, to market observers, to economists all over the world, because it provides us with a really detailed view of what's gone on during the lockdowns. But you can see the number there. You can see the scale is all is dominated by the decline in April. So the ONS thinks that the economy declined something like 20.4%. It'll be somewhere around there. This might be very heavily, be subject to revision, possibly in following weeks, in months, or even years later. So take this with a pinch of salt. But anyway, a big decline in economic output during April, which is a surprise to nobody. It's certainly not a surprise to us. I don't think it's a surprise to the Bank of England, and it's not really a surprise to many economists beyond that. It's there or thereabouts. It's within the bounds that people were expecting. But as you can see, a big dramatic decline. We haven't yet seen what the effect will be on inflation, but you can see the trend is for inflation to come down. So the last data that we have for CPI, that's the Consumer Price Index, which is the rate of inflation the Bank of England are targeting. That's coming at 0.8. But what we call core inflation is around about 1.4%. So there's a difference between the two, and that's mostly made up by big declines in oil prices. So actually the declines in oil prices that have sort of overlaid the pandemic have added to some of the risks that are out there. But you can see it's had this impact on inflation. So when you exclude the impact of those big declines in oil prices, inflation is running at about 1.4%, or at least it was prior to the influence, or prior to the sustained influence of the lockdowns. Our expectation for inflation is that it comes down nearly to zero by the end of the year. But just a quick look at what's happened to inflation over the last decade or so, because I think it's useful. Inflation has been remarkably well behaved prior to this pandemic. In fact, in the US and in the Eurozone, inflation has persistently been below target. So most of the big central banks target 2% as their inflation rate. We do, the Federal Reserve does, the ECB, the European Central Bank, that is, they do, and so does the Bank of Japan. And the Bank of Japan has been unsuccessful in teasing inflation towards 2%. But by and large, the Bank of England and the Federal Reserve and the European Central Bank have done a pretty good job. The UK has had, if you average, say, the last 15 years or so, our rate of inflation has been 2.3% compared to a 2% target. But sterling has been particularly poorly behaved during this period, and certainly in the wake of the referendum. The pound's exchange rate fell, which led to an increase in the cost of those goods and services that we buy from abroad. So that's had an impact on inflation too. But it's a temporary one. By and large, the outlook for inflation is, by and large, the inflation has been pretty well behaved over the last 10 years or so. So where are we going to go? What might happen for the rest of the year? What might happen next year? If we go back 6 weeks or so, the International Monetary Fund released their World Economic Outlook, and they make some forecasts. It's a reasonably well-researched piece, and their expectation was that the UK economy fell by something like 6.5%, well, let's just call it 7% during this year. So that represents a pretty big decline. That's comparable with the decline that happened in 2008. But if we fast forward a little bit and bring it slightly more up to date, in the last few weeks, this is the average of some of the forecasts that I've read through in the last couple of weeks, and the average points to a decline of something like 8.5%. Let's call it 9%. So a big decline this year that eclipses all modern recessions, and even more remarkable about that large decline in economic activity is that it happens all pretty much in 3 months during the second quarter. So during the April, May, and June, the consensus is that the economic output declines by some in the order of 17%, which it looks slightly optimistic when you factor in the April data, but it really depends on what happens in May, doesn't it? And then June will be a better month because the lockdown is being relaxed. I'm sure you've noticed there's much more economic activity going on today than there was 4 weeks ago. Fast forward to next year, and the consensus expectation is that economic output increases by a little over 6%. So we're looking at a sort of big decline this year, followed by a reasonably big increase. I mean, to put 6% in context, the UK economy has been sort of trundling around at 2%. And even when the UK economy was doing very well prior to the 2008 crisis, it was still growing at something like 3%. You know, that 3% represents a good number for the UK, for an economy as mature and stable as the UK's. 6% is a large number, but of course 6% is not enough to get over the decline. So according to the consensus, we won't quite make up what we lost in the pandemic by this time, by the end of next year. I'm slightly more optimistic than that, but we'll see where we get to. So what does this mean for interest rates? So interest rates are very low. The Bank of England's reduced the main policy rate of interest, well, the bank rate that's called. Some people call it base rate. So that's at 0.1% now. There's been some speculation that the Bank of England will turn that negative. I think we'd have to see some significant deterioration from here for them to do that. I'm not sure. I mean, it's certainly on the table. It wouldn't surprise me if they took interest rates slightly negative, but my bet is that they'll be loath to do it. As you can see, long-term interest rates are at very low levels. So even the 10-year gilt is barely registering a positive rate at sort of 0.2%. So interest rates very low, inflation coming down, big decline in GDP. What does that mean for inflation? What is the outlook for inflation? So I'm open-minded about the outlook for inflation. There are some that speculate that very low interest rates plus lots of quantitative easing plus lots of government debt, because of course the government is borrowing a substantial amount of money and will borrow even more money as the year progresses. There are some that speculate that those necessarily lead to high inflation. So two things about that. First off, they don't necessarily lead to high inflation. It's not, you need another sequence of events to occur. So it's not a given. And also it depends what you mean by high too. So to get some indication about where the market thinks inflation might be, we can look at interest rates that are implied through index-linked gilts, for example. So index-linked gilts are linked to the retail prices index measure of inflation rather than CPI. So some interpretation is required, but let's see where we get to. So at the moment, the market for index-linked gilts is suggesting that in 3 years' time, RPI might be something like 2.8%. So RPI at the moment is running at 1.5%, and CPI, as we mentioned earlier, is running at 0.8%. So there's a 0.7% difference with RPI being higher. So if we, I mean, there's no reason to believe that that 0.7 is not structural. It's just a sort of, it's a coincidence at the moment that generally RPI runs slightly ahead of CPI, but there's no reason why that must persist in the future. But let's just assume that it does for the sake of simplicity, and take away the 0.7% from the 2.8%. That gives us a market-based forecast for inflation in 3 years' time at 2.1%, which is only just over the target rate of inflation. If we do the same exercise, but for the 5-year period, because obviously for the next year, year and a half, we're going to see a disinflationary environment because people will be spending less, or at least they certainly are now, let's put it that way. So there's a deflationary element at the moment. But the market is suggesting that yes, there is a definite deflationary element at the moment. Inflation may go to zero by the end of the year, but it's then going to pick up back towards target. So just above target on this measure by the 3-year point, and even at the 5-year point, when I think there's a very good chance that most of the effects from the pandemic will be behind us. Even then, inflation is still on this measure. RPI inflation is coming in at 3.1%, which puts CPI at 2.4%. Now we're being oversimplistic, but what we can infer from the way that markets are priced today is that the bond market is not overly concerned about very high inflation, even at the 5-year point, based on all that we know today. So it's registering slightly above target inflation. 2.4% is that would get the Bank of England's notice. I think they might begin to take some remedial action to bring that back down to towards the 2% target. But at the moment, the markets are very cognizant of the high levels of government debt. They're very cognizant of the very high, the unconventional monetary policy that's going on, and the verdict, at least as far as the market is concerned, is that it is not going to result in very high rates of inflation in the foreseeable future. And that makes good sense. I don't want to give the impression that we're being complacent about inflation, because I happen to think that the risk of above target inflation is one of the bigger risks out there, given where asset prices are today and given how they're priced. I think an unexpected bout of high inflation would be a significant headwind for asset prices. But it's what I might describe as, in fact, let's see if I do describe it as so where have I got? Above target inflation is here. So as far as the risk matrix is concerned, this is how we look at it. The risks up at the top right-hand corner are those that we want to be especially observant of, and maybe take some remedial action, take some diversification action to try and mitigate them. But you can see above target inflation is certainly in the high end in terms of impact, but it's relatively low in terms of probability. So it's in the right hand, but the lower right hand side of that chart. So we're keeping an eye out on it. We'll be monitoring that very closely. But as you can see, the risks to the outlook are dominated by the pandemic. The potential for a second wave. But some of those risks are receding a little bit. So even if we get an increase in infection rates, it doesn't follow necessarily that we're going to see these lockdowns put back in place. I think the risk from a big general mandated lockdown is receding, and in its place are risks that would be much more targeted. So we're going to get targeted lockdowns, perhaps in different places. But they don't have the big impact that the big general lockdowns have. So that's why it's less of a risk to the outlook. But significant risk to the outlook. COVID obviously being the major one, but also we're beginning to pay close attention to some of the geopolitical risks, and certainly the deteriorating relationship between China and the US and the UK and Australia in particular. So still some significant risks out there. But having said that, equity market valuations, equity markets look really attractive to us at these moments in times. I know that there's speculation that the US economy, the US stock market is highly priced. You know, it's recovered much of what it lost during the pandemic. But that's really, you know, it's only certain sections of the US stock market that have done very well of late and recovered much more than they lost. And that's really, you know, there are some technology companies out there that are really benefiting from what's going on. So, you know, possibly those high valuations are justified. But if you look beyond the US market, if you look at the UK market, look at the European markets and, you know, the Australian markets, things like that, then you can see a significantly attractive valuations, at least by my estimations. The same is also true on in the bond market, on the sort of riskier end, in corporate bonds, high yield bonds, things like that. There are some very attractive valuations out there. But just because those valuations are apparent doesn't necessarily mean that they're going to manifest in higher returns. What we really need to see is some kind of economic recovery begin to take hold. And the really good thing is that the markets haven't been particularly dysfunctional. So 2008, for example, we saw large declines in economic output. We saw big movements in equity markets and bond markets. But we saw, you know, we had the Lehman Brothers collapse, and we had nationalizations in the banking sector. So there were some significant problems in 2008, and they're what I call dysfunctioning markets. And the thing about dysfunctioning markets is that they act as a headwind. They're an impediment to a vigorous recovery, which is why 2008 lingered for so long. It took so long to recover from it. What I'm observing in this recession is that the market is performing quite well. The Bank of England, the Federal Reserve, they've all done a really good job of maintaining a proper functioning market, which means that we have everything in place for a vigorous recovery to take hold as and when the time is right. I'm going to speculate that we are beginning to move into the recovery phase, which is good. I think the worst months are April and May, because those are the ones with the lockdowns, and then following that we should see some recovery in economic activity. But it's not a one-way system. We can go back and forth, but we speak from a very diversified position. So we are well placed for a recovery, but we've also got a good degree of safety in place for just in case the contraction lingers. And then all of that is within the context of good financial planning. So we're reasonably optimistic about the outlook from here, realistic as well. I'll leave you there. If you've got any questions, I'm very happy to answer them. If you speak to your advisor, I'm sure they'll pass on any questions or comments. Thank you.